Hey everyone, welcome back to Corporate Decoder. Today Research Alliance Corporation, the third, ticker RACC, just filed an S-4 registration statement, and I'm spotting some really interesting moves happening behind the scenes. Quick note, this is not financial advice, just my take on public filings for educational purposes. My biggest insight here is that this filing is essentially the green light for a massive company merger that is about to change things for RACC investors. Alright, so what is going on? Research Alliance Corporation, the third, or RACC, a shell company looking to merge with another business, has filed this S-4 registration statement. This filing is a big deal because it signals that they've found their target OHB Pediatrics Ltd and they're ready to move forward with the merger. Think of this filing as a formal announcement and a detailed prospectus for shareholders, explaining everything about this upcoming deal. The core of this deal is that RACC, a company formed just to buy another business, is going to merge with OHB Pediatrics Ltd, which is a clinical stage biotech company. After the merger, RACC will actually change its name to OHB Bio Incorporated and will be listed under the ticker OHB. This is a common move for these SPACs. Special purpose acquisition companies to essentially bring a private company public through this merger. Now, who is OHB Pediatrics Ltd? They're focused on rare diseases, specifically developing treatments for Angelman syndrome, a serious genetic disorder. Their main drug candidate is called Rugonersen, and it is currently in phase 3 clinical trials. This is a pretty advanced stage, which is why RACC is likely interested. Angelman syndrome affects about 1 in 12,000 to 20,000 births, and there are no approved treatments that fix the underlying cause. So, there is a clear unmet need here. The filing lays out the business combination proposal for RACC shareholders. This is the main event, asking shareholders to approve the merger. If approved, RACC will acquire OHB Bio. But what needs to happen for this deal to actually close? Several things. First, RACC shareholders need to vote yes. Second, Nasdaq needs to approve the listing of the new company's stock. OHB, third, the domestication, where RACC moves its legal home from the Cayman Islands to Delaware, needs to happen. And finally, there are other regulatory hurdles and the completion of a private placement, the PIPE financing, where investors agree to buy shares at $10 each, bringing in $55 million. This PIPE financing is crucial to ensure there is enough capital for the combined company. Let's talk about the money. The initial investors, like the sponsor who got in early with RACC, are set to make a profit. They bought their founder shares for pennies, and these will convert into OHB shares valued at $10 each. This creates a big incentive for them to get the deal done. OHB Bio also got $45 million in financing through something called SAFEs, which are agreements for future equity. Plus, there is a backstop agreement where Ray Capital Healthcare Fund is committed to buying up to $75 million in shares to cover any redemptions by public shareholders. What does this all mean for ownership right after the deal? If no public shareholders redeem their shares, OHB Bio's original shareholders would own about 42% of the new company. The sponsor and their affiliates, including those who provided the SAFE financing and the backstop, would own around 18%, and the PIPE investors would hold about 17%. But here is the kicker. If a lot of public shareholders redeem their shares, that percentage for the sponsor and their affiliates goes way up, potentially over 40% in a maximum redemption scenario. This means the original RACC public shareholders could end up owning a much smaller piece of the pie, or even nothing if redemptions are very high. Now, let's talk risks. There are a lot, and they're spread across both OHB Bio's business and the deal itself. For OHB Bio, the biggest risk is that their only drug candidate, Rugonersen, might not work or get approved. They've spent a lot of money and have significant losses already. They also heavily rely on third-party manufacturers, which introduces supply chain risks. Then there are the risks associated with the deal itself. If Nasdaq doesn't approve the listing of OHB shares, the deal could fall apart. And remember, these deals are complex and things can go wrong. They also mentioned that their current management team, even though experienced in biotech, is new to operating a public company, which could lead to compliance issues. Let's look at RACC's financials. As of the 30th of June 2026, they had about $833,000 in cash and over $75 million parked in their trust account. But here is the red flag. They have a net tangible book deficit of $1.2 million. This means if they don't complete a deal, they'll have to pay back their public shareholders from that trust account. And if there are too many claims against the company, public shareholders might not get their full $10 back. Now, for OHB Bio's financials for the 6 months ending June 2026, they had over $10 million in research and development costs, a big jump from the previous year, which makes sense as they moved into phase 3 trials. They also spent nearly $3 million on general and administrative expenses, again a big increase from last year, likely due to preparing for this merger and operating as a public company. Their net loss for that period was about $13.5 million. For the full year 2025, their net loss was around $15.6 million. They're clearly burning cash, which is normal for a clinical stage biotech, but it highlights their need for that merger capital. Getting back to the deal itself, the business combination agreement is the main document here. It details how the shares will be exchanged and the terms of the merger. Oak Hill Bio shareholders will receive shares of the combined company, New Oak Hill Bio. The deal's value is essentially fixed at $160 million plus any accrued interest on those safe notes. Let's revisit ownership after the deal. Even with the backstop, if many public shareholders redeem their shares, the original SPAC sponsor and their affiliates could end up owning a significantly larger chunk of the company, possibly over 40%. This is important because it means less influence for the public shareholders who stick around. When RACC shareholders become holders of New Oak Hill Bio, their rights will change because the company will be incorporated in Delaware, not the Cayman Islands. Delaware law offers different protections and governance rules. For example, derivative lawsuits are more common in Delaware, which can be a double-edged sword. Also, the new bylaws will restrict stockholder actions outside of annual or special meetings, and directors can only be removed for cause with a supermajority vote. This is a move towards more traditional corporate governance, often seen as strengthening the board's control. Looking at who owns what before the deal, the sponsor and its affiliates are key players. After the deal, Oak Hill Bio's original shareholders will likely own the largest single stake, around 42%, with the sponsor and its affiliates owning a substantial portion, possibly over 40% if redemptions are high. This concentration of ownership means that a few major holders will have a lot of sway. The initial investment from the sponsor was tiny, around $25,000 for founder shares, which highlights the massive potential profit for them if this deal goes through. Scroll note my take on this S-4 filing. This is a crucial step in bringing Oak Hill Bio public. The company has a promising drug candidate for a rare disease, but it is a high-risk, high-reward scenario. The dilution from the deal, especially if redemptions are high, is significant for RACC's original public shareholders. The sponsor and related parties stand to make a huge profit, which is typical in these SPAC deals. But it also means less direct influence for smaller shareholders post-merger. The biggest risk I am watching is whether Oak Hill Bio can actually get its drug approved and to market, given the high failure rates in biotech. The financial tables show substantial losses and a reliance on this merger capital, making the execution of their clinical trials and regulatory pathway absolutely critical. That is my take. Stay decoded. The research tools I use are linked in the description below. They help keep this channel going. If you found this analysis helpful, hit that like button, subscribe, and join our Discord community.